Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra. Well, are you also worried looking at the current state of the markets? 5 months of losses. This is a 28-year-old record that has been broken. There are SIPs that are already contracting, as we are seeing from the latest numbers. Investors' portfolios are bleeding. But is it the right time to really look at the markets from the way of investing opportunities, or should you be cautious? Everything and anything that you need to know about the markets and of course your investments in mutual funds and the strategies there is something that we will discuss on this special edition. With me joining in is a very special guest, Mr. Swarup Mohanty joins in. He is the CEO of Mirae Asset Mutual Fund. Warm welcome to you, Mr. Mohanty, and thank you so much for taking the time out for this discussion. This is the right time to really get you because in my all interactions that I've had with you in the past, with a smile you have seen all the cycles. With a smile you address all the questions, no matter how worried that the investors, and that's why we've got you. I want to first begin by understanding from you, sir. Are you really worried? And on a scale of 1 to 10, if you can tell me, looking at the state of the markets right now and the fall that we've already witnessed.
This actually on a personal basis, there are two types of people in the market. A buyer wants the market to go down, the seller wants the market to go up. I'm a buyer. So for me, these are good times, these are good values, and the prices are looking reasonable. So for me as a buyer, because I'm a salaried individual, I get salary every month, so I buy every month. For me, these are good prices. So as an investor, I'm happy.
Investor, you are happy. But you tell me, sir, are we near a bottom in any scenario, or are we in for a long-term pain? That's the big question that everybody is asking. Never have we seen before 5 months of straight losses into the markets. 17%, 16% of a fall on the benchmarks, about 25% fall from the peak for the small caps as well. So it's no, and this is only the index level. When we go down the surface, there are many stocks that have really created a lot of pain in investors' portfolio. So are we nearing the bottom, or is it going to stretch for too long?
It's actually not today, but if you go back and Google or whatever we had discussed as a fund house last entire year, and to be fair, I think a lot of people were aware of the word froth going around and the markets being expensive. And then it was always on the cards. But if you look at 5 months versus the last 5-7 months of secular one-way run, 5 months is something which I'll take versus 7 months of one-way, 7 years of one-way traffic on the market. But coming to the basic thought, and this sort of started last year towards the end of the year, when a lot of things happened together. I mean, we had a slowdown, urban slowdown. We had the rupee for the first time not looking very stable. We also had the GDP numbers slowing down. As a result, the FIs also went out. And when you look at that in perspective, when so many things happen together, a market which is a little overbought, not a little overbought, but quite overbought, starts turning the other way around. All said and done, Sakshi, and I will be probably crucified for saying that at this moment of time, even today, in spite of market broadening, the Indian markets are still illiquid. So a little bit of sell-off can have a cascading impact on the market. That is what we are seeing. But having said that, when you look at it from an investor's perspective, buying last year versus buying now, the margin of safety is definitely on the side of investors. I won't say the market is cheap, but the market is definitely far more reasonable than what it was last year.
Okay, fair point. So, sir, if I have to ask you from a retail investor's perspective, we used to discuss right at the beginning of the new year that one should really temper down their expectations with lower returns coming in. I want to just get one thing clear. Do you believe there could be a chance that we enter into a bear market, or do you think that is ruled out for now?
See, worldwide, actually, let's be very clear on one thing. Worldwide, there is secular recognition of India being a growth story. It is also true that last year Indian markets were always expensive, and they perpetually are expensive. So there will come a time when somebody will say the price is good, right? Even today, if you are saying the price is bad and selling, somebody is finding the price to be good for that deal to happen, right? For that trade to happen. But there will come a time, and our house view is almost there. You can't predict the bottom. If I predicted or knew the bottom, I wouldn't be a salaried individual. But we feel the bigger pain is behind us. Some of the correction, as you rightly pointed out, are pretty severe, and especially outside the index, some of the corrections have been extremely severe. So that brings us to the point that we are almost there. A little bit of patience from investors can do a lot of good to their entire portfolio in the long run. Now is not the time to act. In every rocking boat, it's better to sit on the boat, let the rocking part get over, and then you decide what to do. If you've decided to redeem, today is not the day. You will get a day to redeem, but today is not the day.
Absolutely understood. That's a fair point, and that gets a lot of clarity out of the way when it comes to what should you be doing with your investments if you're bleeding red in your portfolios right now. Sir, tell me at Mirae Asset, what is the current allocation towards both equity and debt right now? How much cash component do you still have? And, how are you really looking to deploy that cash?
Actually, we are a fully invested fund by mandate globally, not just India,
Okay.
globally.
Okay.
We
Okay.
believe asset allocation happens at the investor's end, asset allocation happens at the distributor advisor's end. Once they give us money to buy an asset class, we buy the asset class. Now, in markets like this, you'll play momentum versus defensive. Probably a lot of our, which was defensive. If you look at our trackers over the last 2, 3 years, it's very interesting. The last 2, 3 years, a diversified story has not been the best story for returns in the market.
Okay.
When you talked about risk in the last 2, 3 years, risk was completely outside the window. It was completely a return chasing market. So our portfolios have not changed much, but some of the performances have rebounded very dramatically. That's how the markets have changed upside down. And some of you can track the large cap fund, and you'll get the meaning of what I'm saying. Last year, I think March, same time, the large cap was not amongst the top performers. But suddenly, because of the market change, we are looking good, out of turn looking good, but not
Okay.
because our portfolios have changed, because the markets have changed. We backed our conviction and remained diversified in the market, always raised the risk flag over the last 2 years. I think some of our portfolios are looking good. See, if you look at the downturn, clearly financials have not taken a beating. Clearly, IT has not taken a beating. Rest have taken a beating. So funds like us who were a little overweight on financials are holding firm.
Okay, okay. Wonderful. So, sir, from now onwards, since you are just also pointing out that we may be just very near to the bottom, when that happens, nobody can foretell. But, the recovery could start anytime soon or late. But I want to understand, in case you find out new opportunities, which are the fund categories that you expect to perform well from here on?
It's actually when such adversity happens, it's always prudent to go back to the boring core of the economy. And for us, and this is not today, this is last year too. The core economy is backed by some very large pillars of banking and financials. Healthcare is a personal favorite perpetually. Consumption will always be a big part of Indian economy, and hence these three pillars will remain very strong, irrespective of what happens at any point of time. In diversity, it's always prudent to fall back on the core, and that's what one should do. I mean, from a trigger perspective, in January, our house view was this is a year of accumulation.
Yeah.
This is not a year of return generation. The more you accumulate, see, the market goes through a J curve. The more you accumulate at the bottom of the J curve, is your better chance of getting the wealth on the upturn of the market. Now, some of you who you feel should need to redeem are actually writing off the India story. The India
Ah,
story is intact, right? That means you are saying that tomorrow India will not come back.
yeah.
If you know when it will come back and you want to purchase just before that, be my guest. Then you are magicians. I would keep my mouth shut on that. But it is extremely prudent for the long term health of your equity portfolio to gather some beautiful companies at good prices now at this period.
Okay.
You don't have a trigger in this market yet, is a very honest submission. And I
Correct.
don't think in this geopolitical nature of the world, that trigger is going to happen in a hurry. So the longer you get to accumulate this equity at these levels, the happier you should be from a
Wow.
pure maths perspective. So these are great times for SIP investors. These are great times for market accumulators. In fact, I will stick my neck out and saying that people who were, converting their lump sum to SIPs maybe should start Accumulating
Wow.
lump sum from here on will be our view. And this is a house view.
Okay, wonderful. So there's also this entire conversation and debate, largely a controversy of sorts that took place in the recent times, and that's as far as what should you be doing with your SIPs, at least in the mid and the small cap spaces, which were looking more risky. And you also pointed out that some people were calling it frothy as well. So there was this conversation that you should stop your SIPs in small and mid caps. How would you react to such statements? Because they are not statements which are made by anyone but of seasoned investors. And, when such people really make such comments, people listen, investors listen, and they abide by it as well.
Actually, I mean, everybody has their own view. But
Yeah.
from a pure basic SIP investment perspective, there is something called rupee cost averaging. These are markets for SIP investors. You ask any fund manager, the fund manager will say that my aspiration is to buy a good business at a good price. These are good prices to be accumulating, right? You do not know when the upturn will happen, but the more you accumulate before the upturn, simple maths will tell you the units will start giving you more wealth when the upturn happens. Now, people who are stopping their SIPs are giving up on that upturn is a reality. Right? Either you say India story is finished, okay, I'm redeeming equity going home. Nothing wrong with that. You take that call, you go out, and then you don't look back. Now, my humble submission to every investor, every people who have timed the market is, I am nobody to control your money. On the day you are redeeming or you are stopping your SIP, just write down that NAV of that fund on that day. And then in the future, go and revisit that NAV. And then you will know for yourself whether you are right or wrong. The last thing one should be doing is fooling one's own self, right? Now, fine, there is a downturn and it's just a 15, 16% or 17% downturn on the Nifty. If
Yes.
you are uncomfortable with taking that downturn, clearly you are not an equity investor to start with. Let's be very clear on that. These are great times for investors for three things. One is to assess your risk profile.
Yeah.
It's a great time. This market will teach you to become a better investor. The first thing one should do is check one's risk profile. And everybody's risk profile is right. If somebody is not comfortable with a certain asset class, somebody should not be investing in that asset class. So, one, check your risk profile. If it's not your game, you shouldn't be in it. That's point number one. Point number two, the funds you had bought last year for a particular reason, on the longer term horizon, the reasons still remain. Maybe it's a great time to start accumulating those funds again at these prices. If something is wrong with those funds, that's your call, or between you and your distributor. But these NAVs are far lower than the NAVs you are comfortable buying. There's a very simple saying. If you support the market when the market is going through its bad days, the market will come and take care of you in its good days.
That's a wonderful point.
These are great times to be supporting the market for your own selfish good, to be supporting fund managers by giving them inflows. If fund managers don't get inflows, they won't be able to buy this
Yes.
market.
Yes.
This is a fact.
Yes.
Now, I am not of the camp that you should stop any SIP. In fact, I tweeted a few days ago that a 10% top up to your SIPs can do wonders to your wealth creation in the future.
Wow. Okay.
See,
That
the
makes a lot of
SIP,
sense.
yeah, just a 10% top up. I'm not asking for much. A 10% top up in the fund you are doing your SIP, and let us clock the date for today next year, and we will discuss the same point.
Okay, wonderful. Point noted, and that's a brilliant point there. I also wanted to ask you about the sectoral themes, sir. The way they have had a lot of takers, investors were really keen on them as well. They have performed well in the past too. I want to know whether there will be any change in the strategies that investors will have. How do you expect sectoral and thematic funds to perform, sir?
Sakshi, broadly, and I'm stating this from the mutual fund flow perspective, just looking at the broad industry flow perspective. See, every sector, every market cap, every stock has behaved the way they should, right? Problem has been the allocation or over allocation. The problem of last 2 years is people have over allocated themselves to riskier assets.
Correct.
That is the bigger issue. Behavior of the market is not the bigger issue. Now, in India, there is still a lot of confusion, and I'm please forgive me for saying this, still a lot of confusion between what is a sector and what is a theme. Theme is a large a set of sectors.
Correct.
Healthcare, pharma is part of healthcare. Now, our house call for the last 2 years have been healthcare. Please check whether healthcare is doing well or not. Now, banking had not done well in the last 2-3 years. That was also core holding, but it's held up in these, the downturn of the market. But clearly, if you are looking for exotic spots, those exotic spots come with their own risk. Now, how much you allocate is the big question. Again, going back to my whole thing of checking your risk profile, if you have allocated a bit more in the past and are not are uncomfortable with that holding, don't repeat that same mistake in the next time you allocate. Your last thing that one should be doing is buying 1 year performance. In fact, I turn it the other way around. The last 1 year performance, your allocation should be inversely proportional to that. And that's when you stay ahead of the curve.
That's an interesting tip as well. Now, I want to understand, since you were talking about allocation and over allocation, for new investors in the market, say somebody who's under 30 or maybe has just started to invest or is looking to invest in this downturn, what should be their asset allocation from now on?
Actually, everybody's asset allocation is dependent on their life, right?
Yes.
And we've had this discussion in the past.
Yes.
That first the person should ask himself or herself why they are investing. What is the purpose? What are they aiming at? The whole purpose of investing is to make it tangible, and that tangible thing should relate to their own life. What do they want of life? Once they fix that, from that, on the number of years that they want to achieve that goal, will come the return. Now, every asset class has a particular return. Once you fix that return and the return comes to 30%, obviously, none of these asset classes will give you. That means your goal is not something which can be achieved. That's also a way of testing whether your goal is achievable or not. Correct. So every asset class has its own returns, and based on that return that you come to, your asset grid is made. Please, mark myself on this one, is that 95% of your wealth comes from the asset allocation grid, and how you stay disciplined on that asset allocation grid. Only 5% return comes from the market, but 95% of the discussion happens on the market and 5% on the asset allocation grid. So some person who's under 30, first of all, it's fantastic that they're starting investing at that age. It's a brilliant age to start investing. Fix your own whys, and everybody's why is different. Actually, your goal and my goal will be very different. Your age and my age are different. Our life stages are also different. Our dependencies, our liabilities are completely different. So everybody's portfolios are bound to be different. Everybody's allocation are bound to be different. If they can do it themselves, they should back themselves. But I would, at that age, especially for an asset allocation grid, definitely advise them to consult a professional. Form the asset allocation grid first. Finding the right fund comes number 5 in the process. There are 4 steps before that. Don't jump to number 5 first. First you get to a goal, you assess your risk, very difficult to, but you'll have a broad assessment of risk. Then you have an asset allocation in place. After asset allocation comes the fund selection. Don't make it step 1. Don't make us fund guys the heroes. We are step 4. First, you fix up the first 3 because they are questions you ask yourself. Consult a professional. Then picking up a fund is not very difficult.
So you did talk about your own AUMs, the way it's split. You have 1.6 lakh crores, towards equities, and you have about 25,000 crores as far as debt is concerned. The rest is ETF. Is there going to be any change in the kind of ratio that you have deployed your funds towards these 3 specifics? Do you think
that is how the size of the schemes are. Our size, equity fund size around 1,55,000, 1,60,000 crores. We have around 23 to 25,000 crores of debt funds and around 10,000-15,000 crores of ETFs. That's how they are. But from the ETF, from the equity side, we are fully invested. We will perpetually remain fully invested. There will be no cash calls. I think we just launched a small cap, so it's just now that we are in the process of that asset allocation. That will also get completely allocated in the next 1 or 2 months. So we don't believe in as cash calls. I think that's a global view. we remain fully invested.
And what is your own view as far as gold and silver and precious metals are concerned, sir? The way they have outperformed, do you see this space garnering more attention and being seen as more important or critical to everyone's portfolios?
Yeah, I think two things have been big unlearnings for me in the last 4 or 5 years. And not that I was not aware of gold, but that gold will outperform equity on a 10, 12-year horizon, 10, 11-year horizon was something which somebody like me who thought that equity was the only asset, only growth assets, is something which we now have to rethink. There, I'm questioning myself on my 10% allocation to gold, quite honestly,
Okay.
because from a global standpoint, the data points remain fragile, and the fragility of data points, there will be takers for gold at a sovereign level for some time to come. So, from an investor perspective, I keep on saying he or she is spoiled for choice. Equity markets look fairly reasonable compared to last 2 years. Because of the fragility of global data and sovereign buying, gold will continue to find merit in the next 1-2 years for sure. And the third part is, we are entering into a definitely talk about interest rates changing. So debt also remains in favor. So from an asset allocation perspective, rarely do you get all three asset classes favoring you. These are probably the best times to form portfolios.
Okay, great. Well, that's a great note to end the conversation with. We can just continue to go on and on really listening to you, because this is a masterclass in itself, and very rarely do people get to hear from such a wide experience that you have had to share, sir. But many thanks for speaking to us and explaining to us with what lens we should be looking at the current market, as well as, how to really see very, very clearly as to what the outlook could be, and therefore then decide based on, what the outlook promises, and so that you can be in a better state and enjoy the benefits of the lower prices as well. Thank you so much for being with us, Mr.
Thank you,
Mohanty.
Judge. Really appreciate it.
Always a pleasure to speak to you, sir. With that, viewers, we wrap up this special conversation on our special series Market Masters. But do stay tuned on to Business Today Television. We continue to get you such fascinating insights from top market voices, top mutual fund voices, so that you get a clarity as to how are the top investors, ace investors, really taking the benefit of the current fall in the market. Stay tuned to watch our conversations on Business Today. Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra, and this is another special edition of Market Masters for you to be able to really understand what is really happening in the markets and the mutual funds industry, and what exactly is the outlook from here on. We have somebody very special joining right in on the show to discuss